Well, good afternoon, everybody, and thank you for joining us for our second investment webinar in the series. This webinar is going to cover cash management and fixed income in a low-rate environment. And I'm pleased to see that we're joined by trustees from the Channel Islands, Switzerland. We see we've got some from the Caribbean, from Cayman and Barbados. And I can also see we've got some attendees from South Africa and also over in Brazil. So thank you all for making time to dial in today. We really appreciate it, and we hope you find it a useful webinar. So just to recap, in our first webinar, we revisited risk tolerance from a trustee's perspective, and we looked at how the major asset classes have been affected by the economic impact of COVID-19, and in particular, the government responses to the crisis. In this webinar, we're going to look at how the changed landscape has impacted cash management and fixed income assets. And we did ask attendees of the first webinar to vote for the subject for this webinar. So we really thank you for doing that as well. We will also look in this webinar briefly and as objectively as possible at 4 economic pathways potentially for the global economy from here. And the webinar will have 4 sections, and it will last approximately half an hour, and then we will have a panel session with our Chief Investment Officer, David Long, and one of our investment analysts, Matthew Seward, who will be joining us to answer questions at the end of the webinar. Section 1 will focus on cash management in a low-rate environment. Section 2 we'll focus on yields from fixed income assets, and we'll cover sovereign debt, corporate debt, and Section 2 will also unpack and explain some of the investment terminology that we use to describe and measure fixed income assets. And then in Section 3, we'll look at the 4 economic pathways, and Section 4 we'll be joined by David and Matthew. So the webinar will be interactive, and you can post questions and comments on the events feed on the right-hand side of your screen. You'll see I've added a couple of comments there, so please do, if you've got any questions as we go along, add a comment there. But to start us off, I'd like to ask everyone really a general question, and relating to interest rates really, and we've seen interest rates being cut dramatically during 2020. So the question I'd like to ask is, where do you think interest rates will be in 3 years' time? So we've set up a poll for the webinar, and you'll see that again on the right-hand side of your screen. If you click on that poll tab, we've given you 4 options there, from negative rates, 0 to positive. So during the course of the webinar, please do click on the option that you think is likely to happen in 3 years' time, and we'll cover that in the Q&A at the end of the session. So we'll now move into Section 1, where we'll look at the challenge of managing cash in a low-rate environment. And I think looking at where rates are now and the 3 most relevant currencies for trustees, let's just have a look and sort of recap where dollars, sterling and euro rates are. So the Fed funds target rate is between 0 and 0.25. The effective Fed funds rate is 0.05%. By comparison, a year ago, that rate was at 2.5%. In sterling terms, the current UK base rate is at 0.1%, whereas a year ago, we were at 0.75%. For euro, and for any trustees that have euro-denominated clients, they'll know full well that we've had negative rates in euros for a long while, but maybe we've forgotten for how long. So the ECB deposit rate at the moment is minus 0.5%, and it's been 0 or negative since the 11th of July 2012. So we'll now have a look and really see how Jerome Powell, as the chairman of the Fed, and has sort of telegraphed to the market what his intentions are for rates, really for the medium to longer term, and actually his dovish dot plot that was released this month really sort of highlights how trustees and clients and the world in general needs to be adjusted to the fact that interest rates are going to be lower, and they're going to be lower for longer. During this webinar, we will use some visuals, and we're going to start using a visual now. So if you have any problems seeing the graphs that we're sharing, then you will be able to close the chat feed and make the window bigger. And you can do that just by clicking on the arrow next to the time left graphic, which you'll see in the top right hand side of your screen. Okay, so terminology that is often used around rate moves. Often we'll hear about the Fed being hawkish or the Fed being dovish, and I think it's just useful to revisit that terminology and just to highlight some of those key points. So we've seen interest rates cut during 2020, and that's been a very dovish move by the Fed, and typically that's negative for the currency of a country. Typically, it will stimulate or be that action will be taken in with an intention of stimulating economic growth, and typically it would prevent excessive deflation. On the other side, hawkish would tend to be positive for the currency of a country. May be used to slow economic growth, not that that's been a concern lately, and it may be used to prevent excessive inflation. So let's have a close look now at the dot plot, and you've probably heard about the dot plot. You may follow it yourself, but often we'll look at it as managers really to try and see the intentions of the Fed and really what they're trying to tell us about their decision on where rates are being set. So the graphic that you can see here is a comparison of the dot plot from late last year and then the most recent dot plot from this month, and you can see a big difference. The blue dots there, that's the latest dot plot from the Fed, and you can see we're right down in that range of 0 to 0.25%, whereas the forecast at the end of last year was back up in the 1.5 up to 2.5 range. I think what's most interesting about this dot plot is that we can see in the scale at the bottom there that actually it's all the way through to 2022 that those rate levels are at or below 0.5%. And I think the other interesting element here, and we'll come on to it later, is actually then there's quite a sharp move back up after 2022 to position rates where they were prior to the COVID-19 crisis. If we look at cash considerations, in light of the reduction in interest rates, and it not so distant past, you could place funds on a rolling fixed deposit and achieve an inflation plus type of return. And we know often trustees would practically do that to be able to protect against inflation, but also to ensure that any of the trustee or corporate service provider fees were covered by the cash management for a structure or for a client. I think now trustees will struggle to achieve a positive return in sterling or dollars or indeed in euros. I think some trustees may also be grappling with the challenge of having fixed deposits that may not have matured yet, and they may have been at sort of 2% plus, and actually they're going to be maturing into an environment where the rates for fixed deposits that are available now are going to be far, far lower. So what we want to do in this webinar really is to try and investigate that a little bit further, demonstrate where rates are, and then look at some of the solutions that we're finding trustees and institutional clients are starting to utilize to generate that level of return. So one of those areas that you could look at would be money market funds. So if you utilized a money market fund, dollar ETF, you might be able to yield 40 basis points to 0.5% with 2-day liquidity. However, you have to factor in as well that there's a cost of ownership, and you also need a custody account or to be able to hold that, or to hold it within an investment portfolio. And I think the wider ramifications as well of the rate cuts and the government stimulus that has been used in a very short period of time, we touched on in the first webinar, but to look at that again, it's sort of seeing whether that white swan event of COVID-19, whether that might precipitate a potential black swan event in the banking sector. And I think looking at it, financial institutions are certainly more fragile. Business models have been disrupted. You'll see from those rate cuts that bank margins have evaporated. And we do expect to see the credit losses rising, and the profitability of investment banks in the last couple of months has to some extent been masked by the high trading volumes that we saw in the first quarter of 2020, predominantly from market participants that were racing to raise liquidity. I think one other key point, and we'll come on to now, is that a lot of those capital rules that were put in place coming out of the financial crisis of 2007 and 2008, a lot of those rules have been relaxed in a very short period of time. And really those rules were there to try and prevent a crisis in financial markets occurring again. So we'll look a little bit at perhaps some of the potential consequences of the actions of governments in the last couple of months. And to focus on that with a little bit of detail, you probably will be aware of, and perhaps will have followed Basel III and the Basel Committee, which is an international body that are responsible for setting prudential banking standards on a global basis. And they were due to bring in Basel III, and this month, on the 27th of March, they decided to extend that implementation phase by a year out to the 1st of January 2023, with a final implementation also being kicked down the road further by a year to the 1st of January 2028. Now, it's interesting, some of you may have spotted the coincidental neatness of the Fed's message that rates will be lower for longer through 2022, and actually that extension through to the 1st of January 2023. And I think actually looking at it from a numbers perspective, it was interesting to see that the Financial Times had actually counted up that there had been 492 billion in capital relief by central banks and regulators, and that extended from the US, Europe, and Asia, which has mostly come from cutting extra capital buffers. And they're those buffers that I mentioned that were designed to strengthen lenders' balance sheets after the financial crisis. And whilst one can't predict who the next Lehman's or Northern Rock or Bear Stearns might be this time around, we can analyze movements in tier 1 leverage ratios and capital ratios, and look at some of the data that's coming through on financial institutions. And it was interesting, Fitch Ratings have recently commented that on Europe in particular, that it's not clear that EU banks will be well placed for Basel III, even with the 1-year delay. And I think that is something that perhaps trustees should just be conscious of, that there has been a relaxing of a lot of those sort of precautionary framework that's been brought into place to protect clients and depositors of banks. So let's have a look at now sharing a little bit of detail with you, looking at bank stock prices and how they've been affected. So I'm just going to share a visual of that for you. And this chart looks at how COVID-19 has impacted the Dow Jones Bank Index and the Stoxx Europe 600 Bank Index. And year to date, the returns are minus 30%, and they've bounced a little bit in the last week or so, and then sold off again. So we can see that there certainly has been a direct impact on banks through the first quarter and into the second quarter of 2020. And looking at it from a different perspective, here we can see that actually the stimulus from the Fed, from the Bank of England, from the ECB, from the Bank of Japan has created a huge amount of liquidity in the banking system. What we're going to do now is just have a little look in more detail at how the Fed in particular is planning to deploy some of that liquidity into markets. So that liquidity picture that we've just seen sort of highlights how the liquidity is there, and when we look at how that liquidity is being used, it's interesting to sort of lift the bonnet a little bit more on the framework that's been put in place by the Federal Reserve. So in the most recent notes from Jerome Powell, he's pledged to continue the $80 billion per month in buying treasuries, and also around 40 billion for buying mortgage-backed securities. But what the main developments have been is that they've started their corporate debt buying program through the secondary market corporate credit facility. And this has initially been done through buying corporate bonds ETFs through BlackRock. And so far, they've deployed approximately $5.5 billion through this route. They've also launched the primary market corporate care facility, and this is to buy mainly investment grade, but also some high yield or fallen angel corporate bonds. And what we mean by fallen angels we'll come on to on further in the webinar, but really they are recently downgraded corporate issuers that had previously been rated as investment grade and have suddenly found that they're now sub-investment grade. And a good example of that might be Ford as an example of a fallen angel. So those packages, the primary market corporate credit facility and the secondary market corporate credit facility, are the framework that's been put in place under the Coronavirus Aid, Relief and Economic Security Act that was brought into effect in the US. So that the acronym for that is the CARES Act. It's quite an easy one to remember, but then actually looking at those facilities and how they're being managed and actually where that liquidity is being deployed into markets, this just gives you a little bit more detail in terms of how they're going about doing that. And this week we saw another development. On Monday, the Fed announced the creation of a broad market index of bonds that they will deploy capital to through the secondary market facility. And there's a provision under that to allocate up to 250 billion US dollars before the 30th of September. And so this framework will enable the Fed to purchase eligible corporate bonds directly and sort of keeping that primary facility in reserve in case the landscape worsens. And I think that's those facilities and our investment committee, when we were right at the height of the crisis back in February and March, I remember our chief investment officer saying, sort of, where's the cavalry? When's the cavalry coming? And that really is the shape of the cavalry, that they've come in to be that buyer of last resort in the market and to really prop up markets. But there is a question to ask about what the longer term impact of that will be. And some of you may follow US sovereign debt levels and the debt ceiling. It's interesting to note now that the US debt ceiling stands at 26 trillion. When President Trump was inaugurated, it stood at 19 trillion. So we've added 7 trillion in a very short period of time. And the next debt ceiling extension discussions will be July 2021, so not on the horizon yet, but we know that they come around quite quickly, and it tends to be that they'll just keep kicking that can further down the road. And just to illustrate that point a little bit, some of you may view this occasionally, but it just sort of highlights the US national debt in the top left-hand corner there of 26 trillion. But also, I think a point to highlight there is the debt to GDP ratio that has grown considerably. It's now 130%. If you look by comparison, in 2000, it was under 60%. If you don't use this sort of graphic very often, it is an interesting one just to keep an eye on, because it gives you a breakdown of debt in different spaces. So it includes credit card debt, student loan debt. It's an interesting measure to keep track of. But what we'll look at a bit more closely now is from the Fed announcements earlier in the week that they've actually constructed a broad market index of where they will be deploying capital to. So looking at that, you can see the sector breakdown, the sort of the size of that bit of the market, and it's giving us an indication of where that $250 billion might be deployed within fixed income markets. I think we're looking at it from a longer term perspective as well, and the government stimulus and how quick that's been and how dramatic it's been in sort of preparing for this second webinar. I was sort of looking more from a historical perspective and sort of revisited what Adam Smith, the godfather of economic theory, had to say about government intervention into free markets. And I wonder what he'd be thinking now of the Fed stimulus packages. And actually, he was quite experienced in seeing bank interference in markets in his time. And in 1772, he was witness to the collapse of the Ayr Bank, which at the time was a Scottish bank of banks, so not dissimilar to the Fed or the Bank of England in many ways, a precursor to it. And this was a quote or a comment from Adam Smith at the time. And the quote is that commerce and industry of the country, it must be acknowledged, though they may be somewhat augmented, cannot be altogether so secure, as it were, when they are suspended on the Daedalian wings of paper money. And I think that point there is that there's been a lot of stimulus that's been put into the system. And there may be short-term benefits of doing that to prop the market up, but the longer-term consequences of that are still very much unknown. And I think perhaps the law of unexpected consequences and maybe the less than invisible hand of the Fed will stimulate growth. But I also think this is where, and we looked at Taleb in the first webinar, this is where Taleb meets Smith. It could just as easily be that the stimulus actually triggers a future black swan event that, when we look back on it, we might attribute to the Fed. I think generally looking at our notes on sovereign debt, I think US Treasuries do remain the safe haven asset class of choice. And actually, when you look at US Treasuries compared to UK gilts or German bunds, they do still have a more attractive yield. So if we look where yields are at the moment, the US 10-year yield is 0.7%. The German 10-year yield on German bunds is minus 0.5%, and UK gilts are yielding around about, I think it's 21 basis points this morning. It was 18 basis points when I prepared the details. For those of you that are interested in Japan, the Japan 10-year bonds were exactly at a yield of 0 at the time of writing. And I think the takeaway point for trustees from that is that yields on gilts and US Treasuries are also going to be lower for longer. So if rates on cash are lower for longer and yields on gilts and treasuries are lower for longer, it does create a conundrum for trustees when it comes to asset allocation. So we'll look now a little bit more at corporate debt. But before we do, just a very brief note on emerging market debt. And it was interesting to see Moody's ratings agency warning that emerging market debt is likely to suffer more defaults than in 2008. And that could be up to 14% between now and this time next year. By comparison, in 2019, that rate was less than 1%. Argentina has already defaulted on some of its obligations. There's nothing new there, but we've also seen Ecuador and the Lebanon default on sovereign debt this year. And Fitch ratings agency has noted that there have been 29 sovereign downgrades in the first 4 months of 2020. And the UK itself was downgraded by Fitch to AA minus from AA, citing a weakening of the UK's public finances and a fiscal loosening stance caused by the impact of the COVID-19 outbreak. And by comparison, that puts the UK on a par with Estonia, Qatar, and Taiwan. So I think there has been a shift in the credit rating of sovereign debt, but not just emerging market debt, also developed market debt. So if we look more closely now at corporate bonds, we're going to look at a basket of corporate bonds to see what level of returns can be achieved. And we're going to analyze some of the factors that we highlighted in our first webinar. So we'll look at yields on investment grade bonds and how they have fallen significantly and how the credit risks may have risen. We've looked at the downgrades and how they've passed relatively unnoticed. We'll look at how we're expecting failures in the high yield space. And we've seen that junk bond defaults in the US have risen to 5%, according to JP Morgan, and they could rise to over 20% over the next 2 years. And I think there is a fine balance between risk and return, with the whole landscape shifting towards lower returns with greater associated risks. And just a very brief note on hybrids, on convertible bonds and contingent convertible bonds, or COCOs as they're known. In case there was any doubt, the nature of those hybrids could have a material impact on the shape of a portfolio. So if you're a trustee and you have exposure to convertible bonds or COCOs, it's certainly an area that you need to understand the nature of those assets and how movements in markets could impact those assets. So we'll now move on to look in a little bit more detail at some different sectors of the corporate bond market. And this is a graphic from our investment team that we don't mind mentioning was heavily influenced by some details from PIMCO, one of the fixed income managers that we allocate to. And what it does here really, and I think it's quite practical for trustees to get an overall feel for the bond market, is highlights the vulnerability of different sectors to COVID-19. And you can see the sort of sectors that you'd almost expect to see that are less vulnerable. So information technology, communication services, utilities and healthcare, financial sitting somewhere in the middle, real estate as well, maybe just lower than it was, but noticeably that materials and energy have become most vulnerable. The next slide that we wanted to just highlight, and this goes back to the point that we mentioned on downgrades. This just looks at 3 fairly big names: Kraft Heinz, Ford, and Renault, and it illustrates the point at which they were downgraded from investment grade to sub-investment grade, and the impact that that's had on their price. And you can see that sort of point there, where it will have an impact of a downgrade on some fairly large well-known names that you may well have within existing portfolios. You may have exposure to Ford or Renault or Kraft Heinz in your existing fixed income portfolios, but the credit rating of them may have shifted, perhaps without you noticing. So as an investment team, we have seen an increase from trustees and institutions and corporate service providers looking at what can be done within the fixed income space to generate a yield almost as a replacement to the returns that they might have been able to achieve on cash prior to COVID-19. So what we have here is a basket of 24 corporate bonds, and what we're including in there is investment grade corporate bonds. We're looking to achieve, and you'll see the bottom right hand corner, a yield somewhere around 2.5%. But what we also want to highlight here are some of the other key measures that we use and that we feel it is useful for trustees to have a better understanding of. And just to highlight from this, so this is the maturity profile of those bonds, and that's the credit profile of those bonds. So the terminology that we use when we're looking at fixed income portfolios, I think is something that, as within equities, we use a lot of terminology, but perhaps we forget that trustees don't spend all of their time analysing financial assets. So if we highlight a little bit of that terminology here and some of the key fundamentals of fixed income as an asset class. Now, most of you probably know that bond prices and yields have an inverse relationship, so that when yields go up, bond prices fall, and vice versa. And what that actually means is that when you're assessing the yield and the price of a bond, you need to be aware of the impact of interest rate movements. You need to have a base understanding of that relationship to be able to understand the composition of the bond portfolio. And I think one of the other points that often sort of gets missed really is that people tend to focus on the current yield of a bond, and the current yield of a bond is calculated when you look at the annual coupon payments and you divide that by the current market price. And yes, that does give you the current yield of a bond, but what's really more pertinent or more relevant for an investor or for a trustee or for a client is the yield to maturity, because the yield to maturity shows the anticipated return of a bond if that bond is held until maturity, and it's considered a long-term bond yield, but it's expressed as an annual rate. So if I just go back and highlight that in a little bit more detail for you now, you'll be able to perhaps see the difference, which is quite noticeable. So if we have a look there, you'll see for this portfolio, the current yield is 3.8%. Now that sounds like a pretty good yield for a fixed income portfolio. And in many ways, that might be above what a trustee might need it to achieve. But actually, the yield to maturity is 2.62%. And so it's just sort of highlighting those subtleties, if you like, in terms of yields within bond portfolios. I think another area that perhaps gets missed a little bit when looking at fixed income assets is convexity. And the convexity of a bond is a measure that shows the relationship between a bond price and a bond yield. So, for example, the change in the duration of the bond due to the change in the rate of interest. And that leads on to duration, which is something you probably hear a lot about. And again, depending on how much time you've spent looking at fixed income assets, you may have a good understanding of duration. But just to reiterate it's a measure of the sensitivity of the price of the bond to a change in interest rates. So the longer to maturity, the higher the duration. And as a general rule, for every 1% change in interest rates, and that could be an increase or a decrease, a bond price will change approximately 1% in the opposite direction for every year of duration. So again, duration you might see when you're looking at fixed income portfolios, but you may not pay too much attention to it. For us, it's a key measure, and really what we're looking to try and achieve is a short duration within a portfolio with an appropriate level of yield and an appropriate profile of corporate debt from a credit perspective. So that completes the second section, which really was looking at fixed income assets. We're now just briefly going to have a look at some pathways potentially to economic recovery that, as an investment team, we've looked at in some detail, and really to try and look at it objectively. And we're not going to go into a high level of detail here. We may cover this in a separate webinar if it would be useful for trustees, but really just to look very briefly that perhaps if there are 4 paths to consider. Path 1 being there being a full economic recovery and a vaccine. Path 2 being a recovery and no vaccine. Path 3 being no recovery and a vaccine, and path 4 being no recovery and no vaccine. And actually, even since the time that we put these pathways together, we've seen how that shifted a little bit in the last day or two. That actually maybe it's less about a vaccine, it's more about the treatment, even though that might potentially create health inequalities depending on whether you've got access to that treatment or not. But if you sort of look at path 1, that's very much the kind of optimistic path, and perhaps the path that the US would like to think it is on, certainly from a market's perspective. I think path 2 is where we may feel we are to some extent from an investment perspective when we look at how equity markets have recovered the lost ground from Q1, but we certainly don't have a vaccine yet. I think path 3 is looking more bearish, and that's where there's no genuine economic recovery, but potentially there is a vaccine, and path 4 would be the sort of most bearish. So I think we'll maybe cover these. We'll keep that slide open whilst we do the Q&A panel session with David and Matthew, but and I'll leave it up there as well for you to look at some of the detail in there. But I think it is important to look at where we are and to remember that we're in a low rate environment. We thought we were in a low rate environment prior to this. We'd had 10 years of much lower rates than most market participants were accustomed to. We're now in a super low rate environment and potentially a negative rate environment. And I think that does have long-term consequences for trustees in terms of how they are managing cash within structures and for clients, and perhaps looking at fixed income strategies to try and in a way compensate for the loss of returns on cash is something that can be considered, but in doing so you have to be aware of the nature of the risks within fixed income portfolios. So hopefully that was a useful high-level summary of where we are with cash management and fixed income assets. I'd now like to invite David Long and Matthew Seaward to join us on stage, and I can see we've had a few questions there, and I'm just going to try and make room for everybody. There we are. We'll say hello. Hi, David.
Hi.
Thank you for joining us, and hi, Matthew. I think we'll shuffle in where we need to. So I think really wanted to unpack that in a little bit more detail, and perhaps if we turn to you, David, first, just from your perspective. I know you've been a fixed income manager for a number of years. And how dramatic do you think the changes we've seen in 2020 have been? And what is your very high level view of the Fed and the Bank of England and those stimulus packages that we're now starting to see actually impact markets?
That's a lot bundled into one question, and in the short answer is we've seen extraordinary things. I mean, we are 40 years into a bond mega cycle really, and if you had owned bonds certainly 30 years ago and held them all the way through till today, you would have done extremely well in your investment portfolios. And I think the big missing factor that we need to bear into account here is inflation and the outlook for inflation and the impact that inflation has on the real value of your portfolios. And that's important, particularly now when we're starting to look at yields where gilt yields are 0.2% for 10 years. And even on corporate debt, you might be lucky to get 2 or possibly at a stretch 3, but you're having to take some credit risk. And when you have yields at such low levels, you have to ask yourself, well, what's the benefit of owning bonds in that environment? And it's critical to understand the impact of inflation or perhaps, as we're facing right now, deflationary type environments. So very low levels of yield are justifiable if inflation is going to remain low for long periods of time and possibly negative. And don't forget, we've got a really good example of this that has already been experienced in Japan over the last 20 years or so. And in fact, a big investment debate at the moment is whether we in the Western world are about to follow exactly the same path that Japan did 20 years ago. And if we use that as a proxy, in actual fact, Japanese bond yields remained low throughout the period of time. And inflation in Japan remained near zero or negative throughout that time as well. So from an investment perspective, actually to maintain the real value of your portfolio in Japan over that period of time, actually it was perfectly fine to own bonds with little or no nominal yield associated with it. So the second half of your question really was the impact of the Fed and their actions. And there's a number of impacts there, actually. I mean, we've had about 5 trillion of stimulus going into economies or in the process of being injected into economies, and most of that being monetary, but we're also seeing fiscal stimulus as well associated with that. And the impact of that is usually to drive inflation and drive asset prices. But in this context, we need to understand that the cause of it, the reason why it is being done, is because of precisely the opposite, because demand is collapsing, and as a result of that, we're getting deflationary pressures. So what the Fed is really trying to do is to stop or slow down the deflationary pressure that's come to bear right now. I'm not sure whether that answered your question or not.
I think it does. I think what it raises is the question for trustees maybe of how far down the credit scale do they need to go to achieve potentially the yields that they were used to achieving on government debt, because I think that whole landscape has shifted, as we covered in the first webinar, that maybe the returns you were used to from cash are no longer achievable there. You need to look at sovereign debt. The returns achievable in sovereign debt are no longer available there. You need to look at corporate debt. It's all shifted to the left, if you like. So maybe I'll just bring in Matthew, our investment analyst, who I'd like to think is a little bit of a fixed income portfolio architect for us, for some of our institutional clients. And maybe, Matthew, you could just cover the spreads that you're seeing at the moment, and the nature of those spreads and how they've changed and moved out.
Yeah, so we saw spreads we've seen them narrowing over the last 2 or 3 years until sort of December 2019, where they got down to 90 basis points. Then we had a massive spike in March as the coronavirus, basically made all financial assets incredibly volatile. And actually, we found that, particularly in the UK corporate bond market, some bonds are actually untradeable, even though they were pretty highly rated. We think that you're getting paid pretty well, actually, at the minute for investment grade, but particularly high yield. There will be defaults, and defaults will be elevated. But the spreads that you're presently seeing, which are kind of like maybe 600 basis points above home treasuries on high yield, and maybe kind of 300 over sort of investment grade in the US, are statistically kind of pretty good, and they are higher than kind of the average you've seen for at least the last sort of 5 or 6 years. The portfolio, the sample portfolio that we showed you in the slideshow, they were all that's constructed purely of investment grade bonds. We're negative on duration just slightly in that portfolio versus kind of the Bloomberg Barclays, the benchmark, and we're got slightly more credit risk in that portfolio, citing kind of maybe 10% more triple Bs, but a similar kind of quantity of double As. I think one of the unique aspects of that particular fixed income portfolio is we actually cover, on the equity side, almost all of those stocks.
And I think that's an interesting point, is know the assets you're allocating to. And I think the days of sort of rate hunting have become increasingly dangerous, because you can find you've got exposure to assets that maybe are downgraded, maybe do have heightened risks. And I think that is something that even within ETFs, we've certainly seen a big trend in the last month or so, since the Fed has said or started buying those synthetics themselves, that investors have seen that as a sort of a safe haven go-to asset class to allocate to. But actually, we were talking before the webinar actually about the composition of those ETFs, that they're often you end up taking on more risk because of the nature of them. So I wonder if you could just unpack that for us, Matthew, just a little bit, to highlight some of those attributes.
Yeah. So I think the dynamics between kind of buying a passive equity index, which you kind of just buy and you hold everything in the index, and buying a bond index are quite different. Bonds, mature. So there is, transaction costs and sort of slippage from selling one to buy another. But also, I think more fundamentally, distressed issuers tend to issue more debt, and then become a greater part of the index. I think a kind of perfect example of this would be in Europe, where if you buy a kind of passive market index on European government bonds, you actually have a lot of Italian exposure. Now, you might not necessarily want that. You might want sort of German bonds or something like that, which have sort of the negative correlation to equities.
So I think it's that kind of what's under the bonnet. And I think if there's something through this investment series we've tried to highlight, is make sure you have a really good understanding of what's in your portfolios, where you have your exposure. David's been spending quite a lot of time generally looking at our investment themes, and is making sure that your exposure is robust exposure. I think from a trustee's perspective, I think capital preservation has always been key. Yes, you want to achieve some capital growth for the future, and you want to be able to protect against inflation. It's become more challenging to do that in cash. It's become potentially more challenging because of heightened risks within fixed income. And from an equities perspective, we looked at in the first webinar, there's certainly been increased volatility. So I think, again, it sort of heightens the importance of making sure that you've got your investment policy statement up to date and current, and that you know what your tolerance of risk is, that you know what your investment objectives are, and that actually the way your portfolios are being managed reflects that. Because I think their portfolio pre-COVID-19 for a balanced risk portfolio, for example, would look quite different to a balanced risk portfolio that was constructed, or a mandate that was given to a manager now. And perhaps that's one of the takeaways is if there are areas within your portfolios where you think, well, I've just heard about that. I know I've maybe got some exposure to cocoa bonds, or I know I've got some exposure to bond ETFs. It's maybe just picking up the phone, chatting to your manager and saying, well, why are you including that there? What value is it adding? How is it part of the wider picture? I think having that closer relationship and understanding of what your manager is doing, or if you have clients that are trading themselves that are execution only, I think absolutely it's important to understand what they're trading, what they're buying, because of the amount of volatility in markets. I think when we did the first webinar, the VIX index was sat around about 28, so it had come off a lot from sort of March highs of near 80. It's actually jumped back up again in the last week or so. I think it broke through 40. It's dropped back down again a little bit in the last day or two. But we are seeing that volatility in markets, and I think maybe David, you could share a few thoughts on what when we see a drop in yields on UK on UK sovereigns and US. That's probably happened more frequently and to a greater extent in the last 3 months than any time in the last 10 years, just in terms of seeing the shift in yields, but sure, also the speed of the shift.
Absolutely, the moves in bond yields have been extreme, and certainly over the sort of height of the crisis around the sort of 23rd of March, we saw UK gilt yields go from 10 basis points to 80 basis points and back down again within the space of 2 or 3 trading days. That is a very volatile asset class, and it's quite interesting that that's the case. And you made a comment earlier on in the webinar about characteristics of different bonds, and we need to understand that when yields are very low, the price moves associated with a change in yield are much greater. Yeah. And so actually the fact that yields have become so depressed means that there's more volatility within bonds. And I think it just leads me on to a point that I'd like to emphasize for trustees, is that there's very few instances, even in a very low risk investment portfolio, where it's appropriate only to have bonds, or indeed bonds and cash. And the reason is because the diversification associated with that portfolio would be poor. There are some instances, and they tend to be to do with liability matching and portfolios that have specific obligations that they have to meet. But there's very few other instances, and it's a mistake to think that a low-risk mandate means we have to be 100% bonds. It usually means majority bonds, but often other asset classes add critical diversification that improve and lower the risk of the portfolio rather than increase it.
Yeah, no, thank you. And just one bit to point out, so I know we're all in different jurisdictions. On the Isle of Man, we're very fortunate that our Chief Minister announced that the social distancing requirements were removed from Monday this week. So David and Matthew have been able to invite them to join me rather than dialing in remotely to do so. And it would be interesting if anyone does have any questions. And thank you for the request for the slides, which we will share later this week with everybody. But how you, I think as the landscape shifted so much, and it's still shifting, and I think it's shifting for service providers, it's shifting for clients. And I think maybe now, just as things are in some jurisdictions, Jersey, Guernsey, Isle of Man, are starting to return to some form of normal, maybe now is a good time to sit down and review and assess where you are. And I think that point that I made, that maybe you do have funds that are still on fixed deposit that might be maturing in the next couple of months, and they might have been on at 2%. They might, well, they probably won't be able to be rolled over into those same level of returns. I think perhaps as we come up to the end of this quarter, which will be remarkable in terms of the recovery in equities, if it lasts through to the end of the month.
Don't tempt fate.
Yeah, absolutely. Absolutely. I think it will be interesting to look at the first half of the year from a trustee perspective and to assess, one, what has there been damage, what damage has there been, and then two, actually, what is the makeup of my asset allocation? Am I still thinking about the long-term investment horizon, and does the shape of the portfolio reflect that? That is something that we're very happy to help with. We do actually enjoy looking at portfolios and sort of assessing from a quantitative and qualitative perspective, analysing assets. And I think there's one or two other points just to highlight that I think for a trustee, where capital preservation is key, to not be too drawn to assets that might promise uncorrelated returns or might have less liquidity than they should do, or that perhaps aren't marked to market. Because I remember very clearly coming out of the financial crisis that there was a flood of those sorts of asset types, and actually they seeped their way into client portfolios, and some of those assets, clients, trustees, managers are still trying to unwind and get liquidity from now. Often we'll inherit a portfolio that might have suspended assets in it, and those typically will be ones where they might be debt instruments of some sort, where actually perhaps the investor wasn't fully aware of the nature of the asset before allocating to it. So I think that's always a message to have at the front of your mind is make sure you know what you're investing in. If you have any questions about assets, then please do get in contact with us. Happy to still do Teams calls, Skypes, and WhatsApps, even though we're back in the office. I know for some of you might still be working from home for the foreseeable future. So I think we'll wrap up there unless there's any questions coming from any of the participants. I'd just like to thank Matthew and David for joining us. We will plan to do another investment webinar. We'll send out some details of that. Again, we'll send you a little bit of a range of options. What I will just look at to see how people have responded is the polls. So our surveys will be in. I haven't actually put my own response in. David knows me well. I'm quite bearish. So I'm in a camp with a few that think maybe interest rates might be negative. We've got 13% of respondents thinking that, 80% of respondents thinking that that we're going to be somewhere in the range that we're in now, 0%, maybe up to 1%. So 13%. We're pretty balanced. So we've sort of got 13% less than 0, 13% greater than 1, and 75% sat in the range where we are now. So I think that sort of highlights that message from the Fed's coming through, that rates are going to be lower for longer, and actually that's an environment that we've all got to get used to, and adjust our thinking accordingly. I think it's a challenge for us. We like challenges, so please keep sending those challenges to us. I know
the time frame you gave us for the poll.
3 years.
3 years.
So if we're through to 2023, we're still going to be managing the challenge of
75 basis points.
75 basis points. That's your okay. We'll come back in 3 years' time and see whether David's correct or not. So thank you for participating. We appreciate it. I know sometimes it's a bit of fun, but I think it does help to assess the mood of trustees and where rates might be. And actually, I can see there's two that maybe are hopeful it's going to be a little greater than that. But I think we do have to sort of accept where rates are and until the Fed says otherwise in many ways. So thank you again for joining us. We really appreciate it, and we look forward to speaking with you again soon. So have a very pleasant afternoon, and thank you for joining this webinar.